This one chart explains why you keep losing at the worst possible moment. Price range is here for a while. You can see sell side low and buy side above. Then it breaks the high. And that's where retail start going long. Then this happens. You dump back through the range. Everyone who bought that breakout bought the exact top. They didn't get unlucky, they got processed. They were the exit liquidity for the move down. This is the power of three: accumulation, manipulation, distribution. It's the structure underneath tons of traps on the chart. And once you can label it, you can stop taking the wrong side. Let me show you on this exact setup. Then we can look at some examples on a real chart. Accumulation is the sideways range. It's where retail accounts get chopped up and where liquidity gets built on both sides. Smart money is positioning here quietly. For you, this is not a trade. This is the setup zone. You're marking the range high and the range low. The high of the range is buy-side liquidity. Buy stops from breakout traders and stop losses from shorts are stacked above it. The low of the range is sell-side liquidity. The same thing in reverse. These pools are your targets and your traps, depending on which side you're on. Then you have manipulation. Price runs up and takes the buy-side liquidity above the range. This is the false move. Its job is to trigger breakout buyers and stop out shorts before the real move. When this leg happens at session open, we call this the Judas swing. The cue you're watching for is a sweep of the level, followed by a reversal back inside the range. The sweep alone is not the signal. The reversal after is. Distribution. This is the real move, the expansion in the true direction. Here it's down because the liquidity above got taken and the bias resolved bearish. This is the phase you actually trade. Your entries come from reversal patterns after the sweep if you're countering the manipulation, or from continuation setups in the direction of distribution once the move is confirmed. Bias decides which. So accumulation builds liquidity, manipulation takes it, and distribution delivers the move. Mark the range, wait for the sweep, trade the reversal or the continuation. That's the framework. Now let's get into some examples. Every candle is a power of three. So let's go to the daily ES chart. We'll mark the open, the low, the high, and the close. And we'll go down to the lower time frames to see where the power of threes lie. Okay, so we are down on the 2-minute chart. We have already marked out the lines for the open, low, high, close, but we're going to see in real time how the power of three forms, what is the wick, and where expansion is. So let's play through some candles. We have the open, which was here, and we start accumulating. As you can see, we're staying within the range. So you could technically mark the accumulation here. We'll continue. Okay. Now we drop below the range. And this is, as you can see, where we create the low of the day. And as you can see, what created the low of the day is also the manipulation. So accumulation, manipulation, and slowly but surely, we have distribution. Accumulation, manipulation, distribution. Let's go to another example. Okay, so now we are on the hourly chart for gold. And as you can see, we made a recent bearish move. So we are actively bearish. After distribution, we can expect accumulation, which we are actively doing. So let's mark out the area of accumulation. We will mark it with red because nobody should be trading within accumulation. We then continue. And what do we get? So we just swept the high, and now we can do a couple things. We can look at what made this high. What set of candles makes this high? It would be these green candles here. So what a lot of people will do is they will wait for the close below this candle, and then they would enter short. So they would put the high to the, they'd put the stop loss to the high. They would do 2R, 1R, 1.5R, whatever that might look like, and go from there. So we could see how this plays out. And as you can see, immediately we get that. So we get the accumulation, we get the small area of manipulation, followed by distribution. Accumulation, manipulation, distribution. Okay, let's go to the next example. And this is NVIDIA, so you can see that this happens everywhere, even on stock charts. We're on the 4-hour chart. You could go to the daily chart. You can see it everywhere. You have all of this accumulation. You have the manipulation low, sweeping everything out before distribution higher. On a slightly smaller time frame, but nonetheless, you have the low of this accumulation. You have the high of this accumulation. What do? We sweep the low before distributing higher. So how can we use this to start framing trades? This just happened today on NQ. So we're on the hourly chart. Let's just look at this one. We have a range of accumulation happening here. We then have manipulation higher, as we can see here, prior to the distribution down. Okay, so we have accumulation, manipulation, distribution. So let's use these, go down to the lower time frame so that we can frame a trade. Okay, so we are on the 1 minute time frame. And of course, we have the gift of hindsight here, but let's see where we could start framing out trades. So again, we have this long accumulation where it is building up liquidity. It has buy side liquidity, sell side liquidity, and it is just collecting orders. It happens to collect orders all through the night. So this is 11 p.m. all through London, 6 a.m., 7 p.m., and then leading up until New York Open, what do we get? We continue the accumulation. And now that we're on the lower time frame, we can actually get a little bit more accurate here. So as you can see, we continue to stay inside the range. And then we have market open. Market open starts to whiplash here. All right. But again, going back to the hourly higher time frame, this was a very obvious wick with an immediate strong rejection and a close back within the range. So how could we frame a trade out of this? Well, this is slightly challenging because this is a large range up, and this would effectively have to be your stop loss if you were to wait until a close below. Because remember, we look at what made the manipulation leg right here. So we would want to wait for a close below this level. Now, this is a large stop loss. So how would we be framing trades using the power of 3? Well, we have the leg up that creates the manipulation. We wait for the close through, and then we can technically short. And this is going to look different depending on the time range that you're on. Some people may choose to use the 2 minute in this case and wait for this large fair value gap here to get inverted. Once you start to see this rejection on the inversion, you can also start to short there. Either way works. But you could go here to the high, and as you can see, you get a very easy 2R. Yes, we have hindsight, but you get 2R, which leads perfectly into the next range of accumulation. And then in here is where you start looking for continuation models. So you would look you look at this leg here to here, and you would want to see the 50% of this move to be respected, to remain bearish, which as you can see it does. We make a retracement back to the 50, we come back down, we do a little more accumulation, we go for one more try up, we fail to take the previous high, and then we close below. What created this high? This right there. So we could then create another short. This close would have been dangerous. I would have wanted to see this close. So we would have had to go up here. And then you get another easy 2R, which leads into the next one. Again, yes, this is all hindsight, but this plays out constantly. In fact, this was just today. This is a very easy thing for me to find because it was today. You then would continue to look for potential continuations lower. This would also be contingent on where the liquidity is. I don't have any liquidity being marked out. You would absolutely want to ensure that you have liquidity marked out so that you're not selling into a massive premium. And it looks like that would have been pretty close to what was happening here. But regardless, if we go back, same logic, we go from this swing to this swing. We would want to see the 50% get respected. In fact, we are even respecting the 25% in this case, meaning exceptionally bearish, especially when you look, and you could even argue that this is accumulation, manipulation, and distribution. What do? We manipulate, we clear the accumulation highs, and we continue lower. So you would wait, what created this manipulation high? This set of candles. So then what do? We would wait for the close. Unfortunately, you get this big close, but this would actually be a little bit more, I would feel more confident in this because what did we also do? We really just cleared all of this low, allowing for another short. This high, do we get another 2? Yeah, this is an easy 2. And then another 2R. And on this distribution leg, you would have had a setup for 3 separate 2R trades. And this is the power of 3. If you found this information helpful, please consider liking and subscribing. I really appreciate everybody taking the time to watch this video. Thank you.